Okay, testing 1 2 3, testing 1 2 3. The wane in Spain falls mainly on the plains. The ants in France stay mainly in your pants. 3 2 1, hit it. Good morning. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results, but please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. My name is Wayne McDonald, and I am a currency trader. I love being a Forex trader. Global macroeconomics, trend trading. It's good. So right now we have a lot of dollar strength. Holy smokes, at the end of March? Really? Yeah, well, it could be a lot of things. People are crying about a hedge fund blowing up. How does a hedge fund blow up when everything is up? Are these guys using leverage to bet against a trend? Well, good riddance. So anyway, it's kind of interesting. $50 billion liquidated in the last couple of days from one fund. Goodbye, money. Right? Redistribution of income. So anyways, hey, let's do some technical analysis, fundamental analysis. I'll do my best to answer your questions. Okay? Maybe take notes. What's up, Raymond? What else? Ask good questions, take notes, treat everyone with dignity and respect. Professionalism. Hey, man, I got cufflinks on for you. So you're in my office, so a good laugh here and there is pretty good, but let's keep it professional. I'd like to thank Traders Way for being part of our community as well. You're a trader and you're going to need a broker. They've earned my loyalty and respect. Maybe you can give them an opportunity to earn yours. Tradersway.com, open up a demo account. Fast execution speed, narrow spreads, wide swaps, world-class customer service, and above-average looking people. Tradersway.com. Hey, by the way, I wrote a book. Links in the description below. I have training courses, video training courses, self-guided tour of the world called Forex. Link is in the description below. If you want to join my live trading groups, which there are a couple, you have to go through the video training courses first. So either way, you got to start there. So the link is in the description below. You sign up for tradersway.com. The link is in the description below. If you like my chart templates, the link is in the description below. Wink, wink, nudge, nudge. Okay, after doing this for close to 20 years, traders like yourself have asked for resources. Hey, can you do this? Can you do that? Can you do this for me? Can you do that for me? So over the course of 20 years, I said yes. So those resources are now available. Okay, cool. So thank you for being here. Thank you for being a subscriber. Okay, let's get out to the indices. Okay, Aussie's giving back. Kiwi's still strongish, not great. Pound up and down and all around. Okay, Euro was weak and then strong. And Kitty Cad was strong, now weak. Now, what? Yeah, what? Weird market conditions, so you better know what you're doing. You better have some conviction for a trend. Otherwise, as the saying goes, if you don't stand for something, you'll fall for anything. How many people here have a conviction for the next 3 to 6 months and are actively either engaged in trading that conviction or you're waiting for opportunities, but you're not trading Let's say you didn't wake up today to trade simply because the sun rose. Instead, you're actually looking for the price and time that you have planned out in advance and you're waiting. Huh? Yeah. Hoorah! Remember the days you used to wake up and trade just because the sun rose? Remember those days? A million years ago? What do we do today? I don't know. Let's throw down a trade, see what happens. Failure, right? So good. I'm glad you have a bias. I'm glad that you have patience. I'm glad that you have discipline. Right? Okay. Cool. No. Hey, I have a question regarding Aussie Cad. Okay. First of all, they're two commodities, so I wouldn't trade them together. So I don't like cross rates, Nuno. Aussie CAD are not just cross rates, they're both commodities. So they generally may have a high correlation, meaning times when the Aussie's weak, the CAD would be weak. The time when Aussie's strong, the CAD would be strong. Now, there's not quite a strong correlation right now because Australia is suffering different economic conditions, both locally and macro. Both micro and macroeconomic issues, and CAD has a different scenario, but you're still asking me to pit commodity with commodity. The next thing I think of is Aussie's neutral and CAD is becoming neutral. CAD is weak, but a little bit stronger than Aussie. So I'm not sure what you want me to do. So I don't even have that chart. Maybe I have one over here. Aussie, no. I can't even create such a thing. Maybe under CAD. No. Sorry, Nuno. I just can't do it, Nuno. Sorry. Doesn't make any sense to me on a macro level. So I don't even have it as a chart. So that tells me, shields up, red alert. That tells me I don't really, my worst fear, Nuno, is I find a good trade. I don't want to find a good trade because it doesn't make sense. Yeah. So like my fear is I find a trade and the immediate thought comparison, right? The immediate analogy is every single paper I ever submitted at Harvard, I always felt was a beautifully written piece of crap. Like it was formatted properly. It was structured properly, right? My citations were formatted correct. I had a beautiful cover page. And then I'm like, well, this is a piece of crap. And then you send it, put it in. So like the worst thing is I would find a technically good trade on that Aussie CAD, but as far as that type of cross pair, I would just say, but even if it was beautiful, it's probably still a crappy trade. So anyways, that's just my opinion. And it's because I'm a macro trend trader, not just a trend trader. But also, we also know we have to do relative strength. And a quick relative strength exercise would tell me mediocrity. Okay. CAD was likely doing better than Aussie, but other than that, I don't want to know anymore. Okay. Especially with sort of yen weakish, dollar strongish, like it's such a mixed bag that that would be the last trade I'd get into if I were me. Okay. So war. You can see USD Yen would be straight up. Why don't we see if there's a top to this? Okay. And we're exactly at a sell zone if you were a bear. But remember the rules of engagement. Some people say, well, I'm a bear, so I sell at M3. Oh, yeah. But not as the highest high. I mean, you could, but you probably should be more patient. But it's up to you. It depends on your risk tolerance and your aggression level. So there's a big difference between selling this and selling this. Okay, big difference. What? So right now, this is a bullish trend. But one of the things I've been asking the market to show me is a rotation this way. The yen sort of moderately strongly weak, like a strong weakness, not a strong weakness, a weakness. Like I'd like to see sort of yen go neutral over the next 6 months, and I'd like to see dollar get weak over the next 6 months. Okay. And right now we're battling over the 10-year T-note is now what, 1.75? And we're like, oh no, the sky's falling. It's the end of, what are we going to do? Okay. So people are having to deal with that. So one of the thoughts, or one of the things you hear a lot about is inflation, right? Like we're going to be hit by inflation. I think those that are worried about inflation don't understand macroeconomics. So that's why I'd like you to understand macroeconomics. No macroeconomics class today, though. I don't think so. Probably not. Okay. And then next week, I'm going to be on vacation for Easter. So I'm going to be on the beach getting my bronze on. And so a 2-week break from the macroeconomics course. I might do it today, but probably not. Okay. Peter said, so the T-notes are making the dollar strong. Well, yeah, you're a bond trader, right, Peter? Right, Peter? You're a bond trader. If you were hired by a bank, let's say, you'd work in the fixed income, commodity, and currency department. Okay, fixed income of treasuries and bonds. So yeah. Okay. However, doesn't mean it's right. So we have to wait for things to get smart. So like I talk a lot about the United States exporting its inflation to other countries. Okay. It's sort of the cutting edge growth working with catch-up growth. And the consequence of money flowing from the mature economy to the developing economy, right? They get money in inflation. So what creates inflation in the United States if we were going to get it? Harari, 2 p.m. Where does inflation typically come from? What would you ask the Fed to watch? Wages. Okay. What's a good way to gauge wages? Yeah, but you can't do things like observing a black hole in another galaxy where you're like, well, I can't see the black hole, but the way that the light twists when it goes by. No. You have to be able to see it. Price. What kind of price? But see, Gregory's right. Price. But if you don't get it, then you don't get it. Like, how do you determine the likelihood of prices going up before they go up? I mean, after it's happened, it's not helpful, right, Gregory? So how do we do it? average hourly earnings. Okay, but again, why would they go up? You could sit there and observe average hourly earnings not go up, but people are worried about inflation right now. CPI, yeah, but again, it's an after effect. After prices go up, you'll see it in CPI. But how do you know prices will likely go up? So you have something before CPI and PPI needs to be observed. Because you got to remember, people that are freaking out about inflation are freaking out that CPI is going to go up, which is price. Right? But they're already freaking out. We don't have a high CPI, right? GDP, yeah, well, we've had high levels of GDP in the recent past and no inflation. So why are they worried about inflation now? And what would you ask them to watch? Say, hey, well, if you're really worried about it, don't freak out yet, but go watch this other thing. Well, Johnny, they're doing their own interest rate projection. In fact, they're already driving up interest rates, right, by selling the bond market because they're worried about inflation. But what should they be measuring, right? What should they be looking at? So again, you guys are doing all right. You're throwing out pretty decent answers, but a lot of the answers are after the fact, right? So, but we also know like high GDP doesn't mean inflation. We had full employment, right? We had full employment before COVID and no inflation. And people are struggling, like really smart people are really struggling. So you have U3 employment, right? You know this? U3 unemployment. I don't want Georgia, Department of Labor, Georgia. No. Twitter, what? Unemployment help. BLS. Okay. Well, this is what I'm getting to. Let's do this. U3 versus U6. Do you know this? I would guess that the people freaking out about high levels of inflation in the near future have no idea what U3 and U6 is. Yeah. But, you know, these are people that are trading billions of dollars. And then they're like, well, what are you looking at measuring? Like, how do you get to the point of expecting high inflation in the future? Okay. Would anybody like to know? And by the way, Fed funds futures isn't necessarily inflation. It's interest rates. And you say, well, high interest rates are caused by high inflation. The thing is, we have extraordinarily accommodative interest rates right now. Okay. So we could probably have 3% interest rates, but we have like basically zero. So interest rates going from 0 to 3, it wouldn't be high interest rates. And then that wouldn't indicate high inflation. That would indicate normal inflation. Interest rates in the United States have been as much as 5 or 6%. So even if we went from 0 to 3%, which would be a dramatic increase, it would still be low interest rates. So it wouldn't be high inflation doing it. Okay, there we go. Jimbo gets a shiny gold star. Jimbo says, didn't Powell comment about U3, right? That it is not accurate today. Aha. So what should we be watching? And why would it indicate inflation? Does that sound like a good question? There's only 22 likes and 117 people watching. So I'll answer these questions if we can get above 50 likes. Otherwise, I'm just going to move on. I can make you smarter than probably 95% of even the professional market. But you got to click the like button, son. Okay. So anyway, this will be interesting. I'm not predicting this, but I'm waiting to observe it. I'd love to see something like that. Yeah, thank you, by the way. All right, so let me explain it before we read Investopedia's version, okay? U3 is sort of like, it answers the question, do you have a job? Okay? So I have to go all the way back to like 2005. Okay? And back in 2005, Americans were doing pretty good. Rates were pretty high. The world was pretty normal. The Fed could actually manage the economy by adjusting interest rates, and everything was pretty decent. And we could say, if you had a job, we could put that down. Do you have a job or do you not have a job? Would be the question that U3 is asking. Okay? Oh, really, Mike? You should email me some information. That's cool, man. Marina, I'm not as a trade. I'm looking for rotation as an indication that I can load the boat on all my dollar short positions. Okay, so that's not a trade. Right now, that shows the dollar is strong relative to the yen. Okay. But anyways, yeah, so Mike got a job as an investment specialist and used my macroeconomic course, which helped you get the job. Dude, did you just drop the solo growth model on them? You're like, well, obviously we're facing diminishing returns here, but it's a matter of catch-up growth versus cutting-edge growth. What we need is a little alpha. No way. That's killer, man. Of course, you have to send me 10% of your salary. Very cool, man. Just boom. It felt so good, huh? Yeah, right? Cool. Good for you, man. That's cool. All right. So the question that U3 answers is, do you have a job? Back in 2005, people had the job that they were qualified for. People were making good money doing the things that they were doing. Okay. Then we had the 2007 and 8 and 9 financial crisis. The Bush administration scrambled like chickens with their heads cut off. Right? Hank Paulson, for example, got new powers for the Treasury. Bernanke scrambled to get more powers for the Fed, and they spent their time like bailing out AIG, right, for example. And then there was a new election, and then Obama wins. And so now we got new people involved. Hank Paulson, former, chair of Goldman Sachs, was replaced by Geithner. And Geithner was running the Treasury and was going to lead Obama's response to the greatest financial crisis since the Great Depression. So they said in a week, a plan will be unveiled. It gets to the day before the press conference, and a press release is sent out We are sorry, the press conference is delayed by 2 more days. And people are like, what? What do you mean delayed? You told us there's going to be a press conference that you're going to unveil the plan for your administration to save our economy, to save capitalism. And it was like the most important thing right at the beginning of Obama's administration. And they're like, yeah, well, no, we need a couple more days. So all of a sudden people are looking around the room going, holy crap, what if they don't have a plan? So anyways, 2 days goes by. The stage is set. There's an easel with like white flip charts and a marker. You're like, oh my God. They haven't even had time to print anything, right? And Geithner comes out and he's sweating and he's jittery and he stumbles over his words. And people are like, oh my God, there's no plan. There's no government plan. And then they're like, well, we have cars for clunkers. They're like, what? Yeah, if you have an old car, we'll give you a tax credit if you buy a new car. And that was the greatest response. That was the greatest fiscal response over the course of 8 years. That was it. Cars for clunkers. You can trade in your crappy car, get yourself a new car. So car sales went through the roof. Meanwhile, everything else was up to the Fed. Okay? So the only thing that saved the economy was pumping out cheap money. Now we've hit our other crisis and all that kind of stuff, and we're going through it again. So why the U6 thing and why inflation, right? Let's bring it full circle. After 2008 financial crisis, which dropped unemployment to 10%, we got all the way back to less than 4% unemployment. Okay? We went from desperately hurting as an economy where the labor force was severely hurt. Entire industries crashed. Okay? But 10 years later, we're at full employment. In fact, the lowest unemployment rate in the history of the United States. Now, let me ask you, why was there no inflation? U6 measures the quality of your job. It throws in, not because, right? U3, they say, hey, do you have a job? Yes or no? Yes. Good. Then you're like, but wait, I'm a part-time bartender at Applebee's. Sir, we didn't ask you any questions except for, do you have a job? Yes or no? Yes, I have a job. Okay. U6 will say, hey, what kind of job do you have? I'm a part-time bartender at Applebee's. How long have you been a bartender? Since the 2008 financial crisis. Well, what were you before that? An electrical engineer, or whatever the answer is. That wouldn't be the right answer. But, so you're part-time employed and you're underemployed based on your previous jobs or skills. It's sort of like during that 2008 crisis, I had someone, I hired a team. We put in 25,000 plants in my backyard during the financial crisis. Hey, man, I kept our economy afloat. And I was talking to one of the guys that was raking the leaves, and apparently the year before, he was a master builder. He built not just houses, but entire communities. And now he's in my backyard raking leaves. Okay, he has a job. You 3, do you have a job? Yes, I rake leaves. What was your job before raking leaves? I was a master builder. I handled $100 million projects, but now I rake leaves. Okay, so U6 looks at that and reports that. So I think because of a very, very poor fiscal response over the course of 8 years, where the government generally didn't do anything. The central bank did everything. The federal government did nothing. Now, the consequence is people got to work, so they took crappy jobs. They were underemployed, but they were employed. So we had full employment, except many of the jobs are crappy. And inflation did not go up because people earned less than they used to, or they earned less than they should. Okay? So, right? So now Crazy Joe, shows up and like 2 trillion here, 3 trillion there, boom, boom, boom. Okay, now it's giant fiscal. It's all fiscal and it's no monetary policy anymore. Boy, oh boy, I think if 2008 was handled differently, especially through the Obama administration, because I think the Bush administration freaked out, but they shored everything up and then were replaced. Their jobs ended, right? So the next was sort of the recovery process. And instead of doing something useful for the economy, they left it all to Ben Bernanke. And Ben Bernanke saved the United States. So now what? Now we have a lot of people that are underemployed, and their wage growth is zero. They don't have any wage growth. So now we're going to look at that, what's going to happen in the next sort of swath of job creation over the next 3 years. Most likely we're going to get back to full employment again. But I told you even 2 years ago that full employment, and I think I did this in Off the Charts with Wayne McDonald, where we're smoking cigars, drinking whiskey, talking macro, right? Not smack, but Mac, talking Mac. I think I said this back in July, that couple of things, that we're going to have 5 or 6% GDP in 2021. I think the other thing I said is we're going to get back to full employment, but full employment won't be 3.5%. It'll be 5%. Okay. Greg says this monetary policy is a joke. Why would you say that, Greg? Be specific. Just so I understand, because that doesn't mean anything to me. Okay. So anyway, so U6 is going to measure the quality of your job, right? Whether you're fully employed, whether you even like your job. I think it's a question, do you even like your job? Okay, U3 is the rate of unemployment released each month by the BLS. Okay. 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 The official unemployment rate, U3. Reflects the number of people who are drawing unemployment benefits. Simple enough. Okay. Then you go U6. Includes a whole swath. Even I just said swath. Whole swath of unemployed people, namely everyone not listed in U3, means okay, that doesn't say anything. This rate accounts for anyone who has been seeking burping here, who's been seeking employment within the previous 12 months, but unable to secure a job. It includes anyone who's gone back to school, become disabled, people who are underemployed is the key, okay? Or working part-time hours. You're either working for less than you should be, or you're working part-time. See, this is the most important part, right? Okay, this is the most important part. And this is deflationary. Yes, you have a job, but your job sucks. Okay? So if you go back in history, you'll see that while the Fed was raising interest rates because they thought we were going to be hit by inflation. Do you remember that? Before COVID, they were raising interest rates. They were front-running inflation because it was coming. Why was it coming? Well, because we're at full employment. In fact, we're at 3.5% unemployment. So prices have to go up, right? But what they failed to see, and this is the Federal Reserve Bank of the United States, many of which are, the senior leaders have PhDs, maybe 2 PhDs in economics, 30, 40 years of experience of being economic analysts. And what did they miss? Yes, we're at full employment, but people had pretty piss poor jobs. Okay? It's also possible that the labor force relative to historic norms has actually shrunk, which means we have more people permanently unemployed and not even counted in the workforce. Okay? That were disenfranchised during the 2008 crisis, where they never worked again, never planned on working, not interested in working again. And that's probably somewhat a little bit true too. Okay, cool. Yeah, great. Continue, man. Greg, what do you mean by this monetary policy is a joke? I think you got a conversation there. Okay. Okay. I've stayed away from selling dollar because I'm waiting for bullish integrity on these pairs. And right now we're still making series of lower lows. Okay. So I'm just waiting. Okay. This is at a price. It's stabilizing, but it's not ready for me. So I'm not ready to do it. Uche, yen is supposed to be strengthening this time of year. Okay? But what it should do is, so March, you get yen pairs do this. Let me do this. So in March, at the end, somewhere in March, typically in the middle of March, you get yen pairs to come down. And then they do go back up, but it's sort of meh. And now I want dollar to weaken. Okay? But you have to understand, yeah, anyways. All right. So there's, like, for example, the trade plan. So this is what we did on Thursday, then Friday. Now we're here Tuesday, I guess, right? Jimbo's, yep, I can see that, Jimbo. Okay, but the thing is, though, it's one of the reasons that we don't have inflation. So our factory jobs have gone overseas, and wages were dirt cheap, and wages there are higher because of inflation. Okay, like in China, wages are not cheap anymore. There are lots of skilled workers in the urban areas working in factories. Factories are high tech, and those wages have skyrocketed because the cost of living in those cities now have skyrocketed because there's so much work, so much people coming in, so much demand for rent, and therefore workers demand more money and factories have to pay it, and inflation has skyrocketed. Okay. Meanwhile, in the United States, there hasn't been inflation for 30 years. But you have a giant TV and a super powerful computer and a very reliable car, and your costs have actually gone down. Computers have gotten cheaper every year. TVs have gotten bigger, better, and cheaper every year. Okay. Yet you carry around a computer in your pocket. Okay. That's right, Edward, saying manual labor and stuff. But that's a supply issue. Okay. Yeah, Jimbo, typical product cycle though, but on a macro level, which means between countries and over decades. Okay. And when China gets too expensive, and remember they had a one child policy for a while. So all of a sudden they're going to get very old very quickly because they basically lost a generation. And all of a sudden India will be the cheapest place, and it will receive foreign direct investment. Okay. And we'll build infrastructure in India because China will be too expensive and India will be more competitive. Okay. And then once India in 20, 30 years is modernized and wages are high in India, but remember that may take longer than 30 years, might take 50 years because they have more people. They're growing faster, right? Cool. And luckily they speak English versus where, developing China was difficult as a foreigner. Their economies were closed and they spoke Chinese, right? Where the economy in India is more open and they speak English. So it's going to be, but there's even more people than China 30 years ago, right? So be very interesting. But let's say the next frontier after India would probably be Africa. So Africa will probably receive a lot of inflation, or not inflation, investment and development in 100 years. Okay. Okay. So just kind of waiting on some of these big pullbacks, huh? Big pullbacks. Okay. Get rid of this. So we'll see. Just waiting for my time. And I want the dollar to weaken as well. Here we are on the hourly chart. Somebody asked me, why do I draw these channels this way? So that you can observe the breakout. And I think I covered this last week and again yesterday, and I'll reiterate it. But what we're looking at is, okay, range, breakout, range, right? Breakout, range. And that you need to start trapping these things in what you would expect to be ranges, okay? And trade them that way. From support to resistance to support to resistance to support, right? Then breakout and then a new range. Breakout, now a new range. And it's sort of like a trend, but it's not quite a trend. Because we have these forces. So I would still treat this as resistance. And on this bigger time frame, say, this is still very much plausible. And on the smaller time frames, it's doing the same thing. Up, sideways, sideways, up, sideways, up, sideways, down, sideways, down, sideways, down, sideways. Okay, up, sideways, until we regain our bullish integrity. Now, over the next 6 months, not quite over the next 5 or 6 months, I would think generally very large for CAD yen, for example. Okay, do you see this kind of moves here? I don't think it'll continue doing that. I think what would kind of happen is up and then down and then up and then down and kind of create a big range. So like maybe up for a couple of months, then down for a couple of months, and then sideways for a couple of months, and there's your 6 months. Okay. So, up to 90, between 90 and 85 the next 6 months, maybe. I don't know. But I don't expect radical yen weakness like we had since here. Notice on this pair, all you had to do is buy the monthly fib and you would have been, or monthly pivot, and you would have been fine. Okay. This is a buy, first day of the month. This is a buy, right? Last week of the month. This is a buy last week of the month. I guess you could say it this way too. Buy last week of the month, 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 buy last week of the month. Okay. That's what you could have been doing the last 6 months. 6 trades. Okay. Commodities. So most commodities are pretty high right now. I'm looking to buy an ETF. If you guys know of one, I want an ETF that tracks commodities, but specifically has a fairly large exposure to iron ore, American iron ore. And I've been reading through prospectuses and stuff, and I've found out that most of them have very little iron ore. Does anyone know why I would want exposure to iron ore? Let's put this back. Cheaper than gold. That's no reason to buy anything. Robin says they got good iron ore in Sweden. Yeah. You got dwarves in the mountains, huh? Infrastructure spending. Yeah, you guys nailed it for sure. Carol, it's in the swing trading group war room playlist. Okay. So yes, I don't know if it's happened yet. Is it today? I think it's today that Biden's going to announce that he wants $3 trillion in spending, more additional spending, much of which is going to be infrastructure. And so I think we're going. If there's going to be a demand for steel, like to make new bridges and stuff, I want to be in on the iron ore. Polar bears. Yeah, not China. No. Michael's like, give us a hint. Okay. There's the hint. Magnet trains. Some cool guesses. Yeah, Richard, you don't understand. Yeah, you're saying dollar should be weaker because we had bad retail sales and bad GDP. No, you don't get it. You're associating strength and weakness with good and bad, and it's you don't understand. So you need to take them. You need to take a fundamentals course. Johnny says MXI is a global ETF for commodities. Yeah, but so almost all, right? MXI ETF. So I read the prospectus, obviously. Global iShares Global Materials ETF, huh? Okay, so you can see it's done pretty well. So I don't want to buy high, obviously. So I want something specifically geared towards iron ore, not exclusively, but I also don't want to buy commodities at the top. Expense ratio, that's fine. This is about the same as the stock market. All right. Yeah, so it's way up, right? You could probably. All right, so key facts 104 holdings. Holy crap. But I should probably just do this one. Yeah, I'll look at that later. So what is it? No, so no, it's investing into like producers. No. All right, not interested. Pass. All right, let's take a. Yeah, I know they're producers, but I don't want to be involved in production. I want the commodity. Um, Once again, like I don't want to buy Rio Tinto and BHP. All right, so I'll have to continue looking. Yep. Yeah. Oh, so Mike pulls up the actual iron ore futures, but I don't want to buy all iron ore. I don't want to make a bet on iron ore, but the ones, many of the commodity ETFs, they're like gold, oil, wheat, copper, and then after that, hardly anything. So I kind of wanted more industrial focus. So I'll probably have to do a search. Industrial commodity ETF, for example. Let me industrial Commodities ETF. Pro shares sector ETF. No, that's just an ad. Top 9 industrial metal ETF database. Okay, so I could probably look at that. Invesco. So that's a local company. So I'll take a look at this one. So now I'm looking at this. Copper. I just saw it. Where's holdings? There it is. Wow, they're holding a ton in cash. Look, you buy it because it's a base metal fund. But dude, look at all the cash they're holding. Look, oh my God. So 40% of it is other ETFs or mutual funds, and everything else is 60% cash. What the hell? Number of holdings, 8. All right, skip that. Now you got to jump right in. See, you got to do your homework, guys. Do you want to buy an industrial metals ETF that's 60% cash and 40% other mutual funds? Why not just buy the other mutual funds? How many investments they've made, So like if I owned an ETF and I said it tracks the technology sector, but all I did was buy Apple, then my holdings would be 1. If my holdings were 150, then you could say, oh, well, this was much more diversified. Maybe there's smaller companies, maybe there's foreign companies, all that kind of stuff. Okay. Yeah, my pleasure. All right, so bitty. What I was saying is we already know we had our buy at 50, and it's supposed to be on its way to 65,000, and we're now at we're going to hit 60,000 today. So we're already, right? 10,000 is a pretty good week. And if I recall, April is a big month for Bitcoin. So you got some good Bitcoin seasonality on your side. I'm waiting for gold. I didn't do anything foolish. I had a plan. I had a plan that was in demand. I asked it to double bottom here. The next thing for me to buy it is I need a higher high back to the mean, and then a higher low and a roll reversal. And I'll take a little whisper shot, dip my toe into the shallow end around 1750. Probably take a week to happen, and right now doesn't look like it will happen, so I'll wait. Richard says Vanguard. Yeah, Vanguard's a great one. They're super cheap anyways. Vanguard Industrial Commodities. Let's see what they got here. Add, investor, mutual funds profile. Commodity linked exposure will be a collateralized mix of short-term treasury protect. Yeah, but I want that. Okay, energy, grains, industrial metals, 13%. That's pretty good. I could probably do this one, get a little more on the industrial. This is dead or what? Looks like it's dead. All right. They don't want me to use their website. They got it. Yeah, options? No, but no. It's more like I'm investing into it, not trading it. So I don't need an option. The way to use an option for an investor is to do a covered call so that you can liquidate, like you can put some cash in your pocket without selling your position. In Forex, you could right, you can do it because you get paid in real time. In other markets you can't. In an option, right, a covered call. So you could say you're up $100 in Apple and you want to stay in Apple, but you're like, I want to put some money in my pocket, so you can sell a call option to somebody else to say, well, I give you the right to buy this from me at a different price sometime in the future, but you got to pay me some cash now. So you sell that option, which is the right but not obligation. And so now you've got some cash in your pocket, and depending on the move in the stock price, you might have to sell the stock to them in the future. But if you do it right, then you don't. Hope says just buy steel. Yeah, but I want to. I don't want. Well, yeah, I want to get sort of in it more. Okay, I don't want to be exposed to steel production, but more of the demand for the components. But anyways, okay, it's like one of these things. I think I would create more value by being inside the trade more, inside the investment more, than buying the car. You know, instead of investing into the car company, I invest not into the steel company, but instead of investing into the steel company, I invest in the iron ore. Or you can invest into the trains that move the iron ore around. If demand for iron ore goes up, then shipping cost, transportation cost, and supply chain costs will go up. And anyways, whatever. Okay, here we are, gold. We're still on my line. Okay, waiting. Bitcoin, yeah, okay. This is good. Let her come down. I think this has not to do with supply and demand, but overpricing on the canal trade. So I'm going to let it settle. We have our OPEC meeting later. Right, Peter. Selling is an obligation, but buying the call option is not. Correct. So I said, you're selling someone the right to buy, but not the obligation. But selling the call is an obligation, because if they say, hey, I actually want to call this option, and then they're like, the seller has to, yes. Yeah. All right. Cool. All right, fine. Oh, I guess we should do some exotics. Oops. So even though dollar's strong, this should be bad for exotics. And higher interest rates in the United States are bad for exotics. So let's take a look at exotics. Okay. So starting here, what do you see? Let me zoom in a little bit. Okay. There's a top, lower low, lower high scenario, even though the dollar is strong. Isn't that interesting? The dollar is one of the strongest currencies in the world, except South African rand is even stronger. Whale oil B. Robin says, you need a lot of coal to create steel. Yes, you just need you need the iron ore. Coal, actually, you don't need that much relative to the iron ore, right? You just basically sprinkle the top with carbon, which is coal, and you turn iron into steel. So it depends on how much steel you're making, but I don't think it's a lot. So what do you think of this trade, guys? No, that's wrong, Richard. That weakens the dollar. Yeah, I'm going to say it again, Richard. You need to take the fundamentals course. You're not applying proper logic. You're saying stimulus is good and dollar strength is good, so the dollar should be strong. But it's not actually true. So you don't sell. You don't understand. You're just not connecting the dots properly. So you should take the course. Okay. Oh, Keefe got it as cool. Yeah, you got that too. Right on. Heath wants to know why the dollar's strong right now, as we've devalued it to hell and back. First of all, we haven't devalued it to hell and back. Yes, there has been a lot of monetary stimulus and now fiscal stimulus, much of which has actually been saved. And savings gets turned to investment. Investment is not inflationary. Okay? It's incredible, but most of the money that has been sent out has been saved and invested. If you put it in your bank account, it gets invested by your bank, or you buy game stock, but that's also an investment. It doesn't become inflationary until Americans send the money overseas. Okay. Oh, On also is on the rand. Very cool. Oh, I see. Sorry. No, you were saying sell USD. Right. So that would be weak USD. Yes. Yes, a lot of clubs says not with the dollar strength. Right. Very much correct. The thing is, if the dollar turns weak, this should really drop, right? Buying stock is sending money overseas, though. Buying a stock on the New York Stock Exchange, the NASDAQ, the Russell, like, no, it's not inflationary. It's not sending money overseas. You're giving US dollars to somebody that owns a share. So they receive your US dollars and you receive their shares. But that doesn't change the value of the dollar. Okay? If you buy commodities from Canada, then you have to get rid of your dollars and exchange them for the Canadian dollars. So now in the global interbanking system, supply of dollars globally has gone up. The supply of Canadian dollars globally has gone down. So you sell your dollar to buy Canadian dollar. And with Canadian dollars, you buy whatever commodity you wanted from Canada. So you buy a bunch of nickel. And you bring the nickel home, and Canada got dollars. Meanwhile, the globe, the interbanking system, has more US dollars. Jimbo says you're giving US dollar to companies operating overseas. Jimbo, when you buy a stock, the money does not go to the company. If you go out and buy Apple computer right now, Apple does not get the money. That's not how the stock market works. The only time a company gets money is from an IPO. So let's simplify things, Jimbo. Let's say there's a company out there with 1 million shares, and I'm a big investor. So I come in and I want to buy 10% of the company. So I'm going to buy $100,000 share, $100,000 worth, 100,000 shares of this company with 1 million shares. So now I own 10% of the money. Okay? Or it's 10% of the company. Gee whiz. All right. If it's an IPO, if it's the first initial public offering of shares, then I give the money to the company, and the company gives me ownership, which is the right for a piece of future cash flows. Okay? Now, let's say on day 2 of the IPO. So yesterday was the IPO. Great. Now today I come in and I'm like, wow, that was an amazing IPO yesterday. I would like to buy some stock too. I don't buy it from the company. The company has already sold all its shares. The company has already received all its money. They're done. They got their money. They raised $1 billion or whatever it was. Now they got $1 billion to invest into marketing or expand recruiting to have more employees, get new markets, whatever they're going to use the money for. Okay? So Jimbo, if I buy stock on day 2, day 3, day 4, day 5, day 6, a year, 2 years, 3 years, 4 years, 5 years, I'm not buying it from the company. I'm buying it from someone who already owns the stock. So there's a seller of the stock, not the company. There's a stockholder that says, hey, Wayne, I'll sell you my shares for some cash. So I give them cash. They get cash. I get shares. If we're both in the United States, there's no conversion to a different currency. I just own an asset, and they own liquidity. They own cash. Meanwhile, the company is not even involved. The only thing that changed as far as a company is concerned is who has voting rights. Okay? So nothing happens. Think of it as a balance sheet now. So let's do blank. Okay, great. IPO day. Okay. You have the corp and the investor. Okay, the corporation has assets and liabilities on their balance sheet. Investors have assets and liabilities on their balance sheet. Okay? The corporation has shares. The investor has cash. Then there's a transaction. Okay? Now the corporation has cash and the investor has shares. Nothing happened. There's no change. See, there isn't an increase or decrease in the supply and demand of currencies and all that kind of stuff. This happens on an exchange in the United States. The only thing is if this isn't a foreigner investing into an IPO, but see, the corporation has a cash. Now, let's say on day one, the stock goes up 10%. So there's a new investor in town. Okay, they also have assets and liabilities on their balance sheet. So right now they have cash, but they want shares. Now these guys have the shares, but it's already 10% inflated, right? So they're like, oh man. So what they do is they sell the shares for cash plus the 10%, right? So right? Plus the 10%. So they have 10% more cash. These guys got rid of their cash, and now they have shares. In transaction number 2, the corporation's not involved. They're done. They got their money. They're not in the market anymore. Okay? This was between investors. So if you go out and buy Apple Computer today, Apple Computer does not get your money. They don't get any money. Okay? Okay? So Jimbo says, so a company doesn't invest the stockholders' money from buying their stock to spur. No. A company doesn't invest the stockholders' money. No, they sold ownership at the IPO. And then that's it. So in this first transaction, there might have been $1 billion. Okay, the company got their $1 billion, and shareholders now own a piece of the company and have a claim on future cash flows through dividends. So there's just that one day the company raises money, and now it's over. So now the investor gave up cash to own part of this corporation and has a claim on dividends, right? A piece of the future cash flows. And because of the excitement or the belief by the market that this corporation will produce cash flows in the future, drives up the value of the company. And so this investor made 10% one day. They're like, that's enough. They're like, that's great. So they sold their ownerships to somebody else, but it doesn't involve the company. Okay? But the dividends don't come from investors. That would be a Ponzi scheme. The dividends come from cash flows. Okay? So anyway, so on this trade, I'm in here, and I'm in here, and I'm looking for this. Okay. Oh, Hope is thinking about doing some scrap on comics. Well, I don't know when the press conference is. The Biden's going to announce it, but is it today? I think it's today. They're not going to do it as one $3 trillion bill. They're going to do it as 2 or 3 smaller bills. But the idea is that'll be wind in the sails because it'll take years for that money to come to market. So that demand will build up. I don't want the demand to be too quick because you get like that oil move where it, buy the rumor, sell the news kind of thing, where it pops and then it drops. I want steady growth. Blue Boy. I'm not sure what you're saying, Blue Boy, if that's directed at me or not. Can you explain the sell at the top? Oh, this one? Yeah, it's just another big move. Okay. This, and then the previous one up in here. So we've been sellers of this for quite some time. Okay. I can't remember all the ones we were short on. I think we're short at what, 1850, another one at 18, probably another one at 17. Yeah. There's been a lot of trades on this Nuno, so it's just trading the top of the range. Okay. Okay, and so we got to work our way back down. So I think if you go back to the last week of January, maybe the first week of February, Nuno, on the YouTube videos, you'll see that I was short about here. Okay. And this is, I think, like the next new one. And I don't know, just, we've put a lot of trades on that Rand. It's just another trade. Cool. And I've been waiting on these ones. I missed this one. And I never got this one. So I'm just patiently waiting. I know, so sad, right? This one was a monthly exit, if you remember. This was a counter trend setup. But, right, 2150, but in the direction of my fundamental bias. Blue Boy says these scrap charts are scary. Yeah, well, probably a liquidity issue, right? But you could probably do well. It's a liquidity issue, which then leads to an inefficiency. So when there's an inefficient market, there's a bigger opportunity to make money, but also a bigger opportunity to lose money. See, the more liquid it is, the less volatile it is because it's so efficient that there's no giant price gaps. So you'll always be filled. There'll always be a buyer or seller. Yeah, Hope. Well, I love commodities. So, Hope, I know someone that went down to Costa Rica, I think it was, not Colombia, but Costa Rica, and bought enough coffee to fill a container ship and got a good deal. Almost too good to be true. And then while the ship was at sea, the industry was deregulated and prices dropped by like 80%. By the time the ship pulled up to port, they were bankrupt. Is Turkish lira inefficient? It's not a tradable asset. So it's just nothing. Jim says you can. Yeah. Oh, well, it's pointless if there's no market. The chart doesn't represent anything. Correct, depending on the broker, because it's not actually the broker, it's the liquidity partners. You'd be, yeah, yeah, yeah. It's not something that I would train you to be involved in, right? I want you to be a conservative, disciplined trader. There's nothing conservative about trading Turkish lira. Okay. When you think of Mexico, think of trade between the United States and Mexico. Think of demand for things like oil and gold. That's quite tradable. I understand that. The United States and Mexico have, you know, a very close working relationship with each other. Okay. So I understand what that is. And of course, Mexico has, like I said, gold and oil. South African rand might seem, very exotic to many. But I understand their relationship in the world as a commodity producer, but also as an emerging economy. It's not the same as Australia. It's not the same as Canada. So there's some other inefficiencies to this market. For example, the interest rate in South Africa could get quite high where it may not move at all in Australia or Canada. And that will change the flow. So this is a difference between cutting edge growth and catch-up growth, for example. Okay. And because of the structural setup of the country and the economy, they're much more likely to be impacted by inflation, right? Where in places like Canada, Australia, which also produce commodities, they're struggling with deflation. So you have to say, well, what's going on there? Okay. And you have to just acknowledge that it's different. Okay. So right now, 3.5%, huh? Okay. So as the economy normalizes again in South Africa, but also globally, there's a tendency for interest rates to go, let's say, back to 5 or 6%, where I don't think that's plausible in Canada. Interest rates are not going to go to 4% in Canada over the next 5 years anyways, but maybe never. Richard says, does the border control and the issues going on there affect the peso? No. That's not what we trade. We don't trade politics. We trade fiscal policy, monetary policy, and international trade. Okay. So, one of the things we may want to pay attention to is the likelihood for South Africa to raise interest rates in the near future, back to 4%. And if so, that would be a new policy of the central bank, and that is likely to increase the value of the currency. And if their currency can buy more stuff, it'll help fight its natural rate of inflation, because its growth rate is faster, its inflation rate will be faster, and then its interest rate should be higher. Okay? So that's kind of what we should be watching for. So let's go here, for example. Okay. So let's say the natural rate of inflation in South Africa is 7%, and it's 2% in Canada. Okay. On says the South African Reserve Bank expects oil to hold at $62. Why? Where'd they get that number from? Okay, now you have to go back and simply look at things like, what does the EIA say? What does the IEA say? What does OPEC say? What does Royal Dutch Shell say? What does Exxon say? And what does BP say? You throw it all together and it probably comes out to $62. But it seems silly for, the South African Reserve Bank to make a prediction. It's not their job to make a prediction. Their job is to analyze their economy. And you're like, okay, one of the variables, right? But it wouldn't be their prediction. They'd have to say, well, these, let's say 3 or 4 or 5 energy, institution of energy, right, have come up with this number. They predict. They should say these institutions estimate oil to be in a range of $58 to $62 in 2021. Therefore, versus we say this. Well, dude. Okay. Whatever. But you see the difference? 7 versus 2. So a carry of 5. What? I'm going to do it off the double top. Or what? Let's do it this way. Insert indicators, custom, price action pivot points. So I'll pay attention with this. Cool. Nice. Peace on earth. May the pips be with you. May our profits be above average. See you tomorrow.